looking for a program to start a business, grow an existing one, or manage your personal finances? Your search stops right here. Join Mukonke Mukonkela from Inside Partners Africa every Tuesdays at 0:20 hours on the Dalama Insights Business Show, a program that gives you the best and most practical, actionable insights.
Good morning and welcome to another thought-provoking episode of the Dalama Insights Business Show. I'm your host, Leslie Sinyango, and today we'll be discussing the art of diversification in the world of investments. Now, diversification is a critical strategy in the financial world, one that aims to reduce risk by spreading your investments across various options. It's often likened to the adage, don't put all your eggs in one basket. Mkonki, it's a good morning and welcome to the show.
Good morning, Leslie. How have you been?
Very well, thank you. And how are you?
Good. How's the week so far?
We're pushing.
Yeah.
That's the Zambian adage.
That's
We also have our own thing. We're pushing.
That's a Zambian adage. We are pushing.
We're pushing. Yeah. All right, but can you explain what diversification is and why it is so important in the world of investments?
Thanks, Leslie, and good morning, listeners and viewers on LinkedIn. I can see already Lubase has joined us. Good morning, sir. So diversification, as you've said, Leslie, the adage that is commonly known is don't put all your eggs in one basket, because when that basket drops, it means that you lose all your eggs. So to diversify simply means looking at different investment options other than the ones that you already invest in, so that you can mitigate or protect yourself against risks that you expose yourself to in certain investment vehicles that you might use. So this strategy is very important to help investors to protect themselves against losses that might occur in a certain investment area. For example, I'll give an example of if you invest in investments that are exposed to inflation, for example, the government bonds or any fixed income might be exposed to erosion of a return on investment due to inflation, which as prices increase, the value of the kwacha reduces. So that risk also is felt even when it comes to your investments. So when we consider diversification, we're simply talking about how you can spread this risk across different investment options so that you can reduce this risk.
Now let's elaborate further on this. How does diversification allow investors to balance risk and create equilibrium in their investment portfolios?
Thank you. So there's normally another adage that says there's more risk, there's more return. But you need to make sure that you understand that depending on one type of investment might result in a loss. If you put all your eggs in one basket, when the basket drops, you will lose out. That is the essence. So when you depend entirely on one investment type, you are exposing yourself to risks. So you need to balance between the risk as well as the return that you're expecting to make from that risk, so that you can spread this risk across different investment portfolios.
Now, could you share why a lack of diversification can be problematic for investors, especially those seeking quick gains, and how diversification goes beyond just spreading investments within a single asset class?
Those looking for quick gains, these we call speculators, and they normally take on a lot of risk. What's important to understand is that when you invest in a variety of investments, you are actually protecting yourself from fluctuations in the market that might affect a particular investment vehicle. I already gave an example of the government bond. You can look at including investments such as real estate that might not be exposed to probably the risk of inflation or the rise in the interest rates. So if you consider other investment portfolios or other investment vehicles, this will really help you to create an even distribution of risk, so that when one area of your investment is not doing well, you'll be covered by another area of investment that is doing well, even considering the current economic environment or prevailing economic environments. There are certain investments where even if inflation or interest rates are increasing, inflation is rising, the cost of living is rising, actually do well even in such conditions. That is why you need to include those in your investment portfolio, and that is really what the key is. Yes.
Kongi, can you illustrate the importance of diversification, like through an example? How can diversifying within different asset classes like stocks and bonds help investors navigate market uncertainties?
Thank you. So an example of how you can carry out investment is when we talk about diversification, actually we're talking about looking at one particular class and how you can use that class differently. So for example, if you invest in the stock market, you can decide to say you're going to invest in stocks that invest in mining. If we're talking about Zambia, maybe there are companies that invest in mining. You could also talk about not just investing in companies that operate in the mining sector, but you could also consider buying stocks in companies that are in retail. Like we've got a number of retail outlets. I know there's one that's listed on the Luce, that's ShopRite. You could consider investing in a company that is in retail. You could consider investing in a company that is in mining. You could also consider investing in a financial institution. So when you consider buying stocks, if you want to diversify your stock portfolio, we're talking about you buying stocks in companies that are in different industries. So if you've bought stocks maybe in a mining company, you've bought another stock in a retail shop or outlet, you bought another stock in a financial institution, then we could say you've actually diversified your investment portfolio when it comes to the stock market. So that's an example of how you can think about diversifying your portfolio. You could, if you're talking about these stocks, you could also include mutual funds or unit trusts. You could also put some of your money in unit trusts. So that way you've spread your risks across different industry sectors. So when, for example, if the mining production is not well, the mining sector is not doing well, copper prices, are very low, you can always rely on a retail outlet. Financial institutions normally do relatively well. If you are lucky to buy a stock in a financial institution, you're going to be making your dividends and your capital appreciation from that investment. So that's how you need to start thinking about diversification.
Now, Mukonke, you've mentioned asset allocation as another important strategy. Could you explain the difference between diversification and asset allocation and why both are critical in building a strong investment portfolio?
Thanks, Leslie. So when we talk about diversification, we are normally talking about one single class of investment. Like the example I gave earlier, I was talking about investing in the stocks and then choosing different industries in the stock market. Asset allocation, which is also very important, looks at investing in a completely different investment vehicle. So whereas you have an investment in the stock market, you should also consider investing in real estate. So the stock market is completely different from real estate or property. In addition to that, you could also consider putting part of your money in the government bonds or treasury bills. Again, these are completely different asset classes. So even as you consider how you manage your risk, you need to consider both diversification as well as asset allocation. Okay. Asset allocation, I've explained just now. You need to invest not just in the bond, put part of your money in real estate, put part of your money in the stock market, put part of your money in commodities. There's even commodities where you can buy, copper, gold, and, keep it somewhere, preserve it. When it appreciates, you can make your money from that. So that is asset allocation, Leslie.
Okay. All right. You are listening to the Ndalama Insights Business Show, and today we're talking about creating a strong investment portfolio, the key principles and tips. We'll take a short break. We'll be right back.
You are still listening to the Ndalama Insights Business Show, brought to you by Insight Partners Africa. Leave your comment or question on Mukonke's YouTube channel. The Ndalama Insights, turning your challenges into actionable insights.
And welcome back to the Ndalama Insights Business Show. And today we're looking at creating a strong investment portfolio, key principles and tips. And with me in the studio is Mukonki Mukonki. Remember, you can follow this live on YouTube as well, and LinkedIn. Simply search for Mukonki and you should be able to find that live. Now, Mukonki, could you briefly touch on the key income producing assets, such as stocks, bonds, and cash, found in a well-diversified portfolio and their respective roles in balancing risk and return?
Thank you. That's a very important question. And I'll try to take my time then as we are running out of time. So when you speak about income producing assets, we are normally looking at various assets that give you a fixed income compared to those that might not be able to give you income in the short term. So the two examples I can give you are bonds. Bonds are fixed income producing assets. This is because as I've been teaching over different programs since June, I've been saying that bonds will give you a regular coupon income. In Zambia, we get it after 6 months, biannual coupon income. That is a fixed amount that you get until your bond matures. With the stocks, and this comes with a relatively lower risk because of the certainty of your return on your income and the fixed nature of this asset. The risk is relatively lower compared to stocks. Stocks give you a lot of return, but come with a lot of risk as well. First of all, when you invest in a stock, you are buying a stake or a part of a company. And the company, especially if it's ordinary shares that you are buying, the company has to be able to make a profit before they can declare a dividend. And that means that is when you'll be paid. Therefore, if this company is not doing well and never declares dividends, it means that you may never get paid until that company declares dividends, unless you're a preference shareholder, meaning that your shareholding is slightly different from the ordinary shareholding. So what's important here is, this is why we're talking about balancing your investments. You can be so excited about the stock market because research indicates that stocks perform better than bonds in the long term. You make more money from stocks than bonds in the long term, but you also have to weigh the risks and maintain this asset allocation well, so that you can maintain some or earn some regular income through a fixed income producing asset, but also ensure that in the long term you're able to make much more money from investing in the stock market. So that's what it is.
Great. Now, Conti, would you finally mention some additional components of diversification, like real estate, asset allocation funds, and international stocks, as well as briefly explain their roles in enhancing diversification?
Yeah, this is nice. I would love to talk about international stocks because, our stock market in Zambia, let's be honest, is not really up to par. And so if you are really interested in investing in the stock market, you can go international. And all you need to do is find a stockbroker who's based in the country where you want to buy the stocks. And then work with them, and they should also be able to work internationally with international investors outside their country. Consider investing in stock markets other than within our country, because look at the companies and the performance. What you need is dividend paying companies that have shown a history of making profits and are able to give you regular dividends. I've said that in 2024, this year I focused so much on bonds. In 2024, we are going to touch on the stock market quite a lot, and see how this can be an important aspect of our investment portfolio. So we will spend some time learning about the LUSE, investing in a few shares on the LUSE, and just trying to understand how this market works. It's a difficult market, and you can tell from the shares and the prices, they never change. Even when the economy is not doing well, or when the economy is doing well, the share prices that we have of companies on the LUSE is fixed. You wonder how it works like that. So let me end there.
Now, maybe it's also the fact that we don't have that many subscribers yet. We're not at that stage where there's too much trading going on.
Yeah, that's also part of the issue, Leslie, which is why I think programs like the Ndalama Insights are very essential. And also, I always advocate for government to push for investments, Zambians to start investing in the stock market, and even companies to start listing their companies on the LUCE, rather than just focusing on getting financing from financial institutions. SMEs are always look at financial institutions as probably the only way they can get their businesses funded. But we have a stock market where they can go and list their companies and actually get money from the public. I know Zambians are afraid of selling a stake of their business. They want control, full control. But look at it in the long term. You won't have capital to grow your business. Your business won't grow. It's better you grow your pie and make money and share that pie with others, rather than just have full control of your company that never grows. We've got a lot of Zambian companies that have been stuck in one position for years. Walk around your neighborhood corner, you are going to find that businessman is the same.
All right, now let's look at the age breakdown for diversification. When should investors be more or less risky with their investments based on their age and financial goals?
This is also very interesting. So the older you grow, it also affects what kind of investments you need to focus on. This is because when you are younger, Leslie, that's why you are still young, Leslie. You need to you need to take this into consideration. When you are younger, you can invest in the stock market. This is because the stock market earns returns over a long period of time. I mean, when you invest in the stock market, you even need to really forget about it. You can monitor the performance of the stock, but don't expect to make money today. It's a long-term investment. You only see the return over a long period of time. So when you're younger, you've got that time to spend and wait for that return. When you're older, nearing retirement or even in retirement, you don't want to spend half of your money in the stock because you've just got a few years to go. So you need to switch your investment portfolio and focus on income generating assets like the bonds and rental property and others. So this is what this asset allocation is, depending on how old you are.
Okay.
Yes.
Now, could you provide a few examples of how this age-based diversification might work for investors at different stages of life?
Oh yeah. So quickly, what you need to do is take your current age. How old are you right now? If you are, let's say, 20 years, deduct from 100 years. That will give you an idea of how much you need to invest in the stock market. Meaning that if you are 20 years, you can invest at least 80% of your income in the stock market, and then the 20% can be invested in the bond. If you are 40 years, it means that you need to invest at least 60% in the stock market and 40% in the bond. So it means that the older you grow, if you are 70 years, you need to invest at least 70% in the bond and 30% in the stock market. This is all because of the long-term nature of the stock market in terms of returns. And this is how I can simplify this. So for those of us that are over 40, the stock market might be something we need to start easing on and focusing on income producing assets.
Okay, and if you found this as complicated as I just found it, please search from Konkem Konkel on YouTube. You can review it and watch it a bit, and I'm sure you will be able to understand it as well.
Leslie, I thought I made it easy. I really thought I made it easy.
There is a lot to take in.
Can I take a question from Lubase? Just one.
Okay, please go ahead.
So Lubase is saying, is it a good strategy to diversify when starting up investments? It depends. So you'd obviously start with one investment portfolio. Then as your income starts growing, definitely start looking at diversifying your investment.
Okay.
Yeah.
All right. Now, in conclusion, Konke, can you summarize why diversification is a prudent strategy for investors, as well as emphasize the importance of finding the right strategy that aligns with individual financial goals and risk tolerance?
Diversification is important because it helps you spread risk across different asset classes, as well as helps you to invest in income producing assets, which will enhance your potential for rewards later on. So that is what I would say. And we've done a lot of programs so far. I will be doing a training workshop at the Radisson Blu in December. More information will start coming out very soon, 15th and 16th December, where we cover in detail all these things that we've been talking about on this program.
All right. Konki, thank you very much for your valuable insights today. And thank you to our audience as well for joining us on this episode of Ndalama Insights Business Show. We definitely do hope you found this enlightening and that it empowers you to make informed investment decisions. Until next week, good morning.